All right, hello, good morning, good evening, and good night. I hope you guys are doing absolutely fantastic because in today's video, what we're going to be doing is I actually have a topic very similar to what the dividend bull was talking about. In this video here, he says, this is why you should invest for high dividends over growth. And I'm going to be making a similar video to his video. So if you guys do know the dividend bull and like his channel, you'll probably also like this video, not gonna lie, because we're gonna be comparing low dividend yielding companies such as Lowe's, EPD, which has about a 7% yield. We're gonna go up to a 10% yield with PennantPark. PFLT is the ticker symbol, which actually the dividend bull did in his video. And then we're also going to be comparing Clip using a dividend calculator. So what we're going to be doing in this video is comparing low to high dividends. And I'm going to tell you guys exactly why I choose to invest in high dividends like the dividend bull, just for the cash flow and the compounding reinvestment and the snowball. So if that does sound good, please do remember to subscribe. We're up to 3,561 subscribers, just passed into that 560 subscriber route there. So that's awesome to see. Last video didn't do as well. You know what, 543 views, who can complain with that? It's okay. It's still a great video, decaying stocks and why they aren't as bad as most people think. Now, getting into this video right here. So what we're doing, comparing low dividend yields, 2.2% from Lowe's, to high dividend yields, working all the way up to Clip at the end. So starting with Lowe's, we're going to enter its share price in 207. And what we're going to do for each investment is we're actually going to do a $10,000 investment. So you could see that's roughly about 50 shares of Lowe's for a $10,000 investment. Now, when taking into their dividend percent, and I do understand that Lowe's does grow a dividend, like their dividend has a good growth rate, but we're really going to look at the dividend amount currently and how much we're getting paid because we really want to snowball our dividends fast. Now, for an annual growth rate of about 2%, or annual dividend of about 2% with a $10,000 investment in Lowe's, you're looking at about $256 from dividend income annually. So from $10,000, you'll get about $250 in dividend income. Now, it's not super amazing in my opinion. Obviously, that dividend will grow. They'll grow it at about 10% every single year. But with compounding and reinvesting, we could probably grow that a lot faster with these companies here. So looking at EPD, we're looking at a 7.6% dividend and about a $26 stock. So putting that in here, we have a $26 stock, a $10,000 investment as we're doing with all of them, which gives us roughly 385 shares. We have a dividend yield of about 7.6%. And we have drip on with everything. Of course, we are going to be reinvesting our dividends. We did the same thing with Lowe's. And as you can see, we have about $1,469 from a $10,000 investment. So you could see here about a 15% return from a $10,000 investment per year. You can see here the yield on cost, 15.81. So that is something interesting to see. Now, as we bump up these dividend yields, we're going to 10.7 on roughly an $11.50 stock. This is PFLT. And this stock actually, the dividend bull, he kind of goes back to it in his video. But just looking at the historical prices for the kind of length of this stock, you can see here that they actually been pretty much paying out the same dividend and increasing over time here. See, there was a couple of dips as they went up and down, but for the most part, 2021 to 2023, they were increasing their dividend, which is interesting to see for a high dividend payer. So now going to our investment calculator, we got an $11.5 stock. We need $10,000 worth of this investment, roughly $870. And actually, the one really good thing about investing in stocks with a lower share price is if you don't have fractional shares, it's easier to buy back more shares than, let's say, you're investing in Lowe's where you have to buy a whole $200 worth of shares. You can only purchase about $11.50 worth of shares with PennantPark floating rate capital. Now, going to everything, we have the drip turned on, $10,000 investment. We're calculating this dividend. You can see we're actually doubling our dividend from enterprise products. But the thing is, our dividend didn't double. It's a 7.6 dividend here. Our dividend went up about 3%, and our total dividend income went up over $1,000. So now you can see here from a $10,000 investment, we're making about $2,671. A yield on cost of about 30% per year. And obviously over a 10-year period, a total return of about 175%. Now, maybe I forgot to mention, we are doing a 10-year period. Lowe's, enterprise products, Pennant Park, all done on a 10-year period. Now, going to a really significant dividend payer, which is Clip, a distribution rate close to 50% at 48.5%, we'll say. Clip is a $16 stock. 16, what are they at right now? 1638. Let's do it to the extreme here. 1638. We need a $10,000 investment, same as the others, which will give us about 610 shares. Our expected dividend about 48.4. We'll just undermine that slightly because it's 48.5. But when we go here and we calculate with, actually, let's do without drip first. So without drip, just taking your money out, you're looking at about 4.8 thousand. Now to show you the difference with drip quickly, you're looking at 168,000. If you obviously see this difference without drip, 4,000, that's just taking money completely out of Clip. But with drip, you're looking at significantly higher returns, an annual return about 500%. Obviously, absolute returns. And is Clip's dividend stable? For the most part, it has been stable. Looking at the long-term price chart of Clip has gone straight down pretty much, although it is kind of flattening out a little bit slightly. Clip relies on KWEB, which is the China internet sector. That is the underlying index, but they pay out a 50% dividend. And if Clip is able to keep this up, you can see the snowballing returns. This is from a $10,000 investment, turns into $170,000 per year in annual dividend income with drip on, so with dividends reinvested. And that goes back to the $10,000 invested in low, which only returned about one full share of Lowe's, which was $256, comparing that to Clip, obviously with much higher cash flow when you reinvest those dividends at $178,000. So I hope this gave you a little bit of an indication why I kind of choose to use high dividends compared to low dividends, because I'm looking for cash flow now. And the higher, obviously, your dividend is, and the more you reinvest, the greater your annual dividend income is going to be. And with this annual dividend income, what could you do then? You have so much coming in. You can literally take this $200, is what I currently receive from annual dividend income, and you can buy back shares of EPD, or you can buy long-term dividend stocks like Lowe. So if you do have massive dividend income coming in, you can choose exactly what you want to do. You could choose to reinvest, or you could choose to play a long-term approach and buy solid companies at hopefully great prices. So if that video did obviously serve you well, I want to say a shout out again to the Dividend Bull, and thank you for this video idea. I did take it from him. And so I want to say thank you for that, obviously. And I want to say thank you to you guys for subscribing and obviously sticking around in our channel and enjoying the video. So without further ado, I want to say thank you. I hope you guys learned something today, got some interesting information on high dividend yielding stocks. I hope you guys do take care, and I will see you guys next time.